All right. We are now live, guys. Welcome, everybody. I see the participants starting to flow in. And I love how many people we have registered for a Saturday, right? I mean, it's amazing how many people we always get all of these Saturdays at 1 o'clock every week for these webinars. You know, it's like I get it if people want to tune in during the week and tune out during the weekend. But I mean, I think what makes this community different is that we seriously do have so many people who love the markets and want to make themselves better. And while we're waiting for everybody to stream in here, guys, why don't you go ahead and drop in where you're from? I'm always curious to see that. I'm hanging out here in my house. I've got some construction going on behind me. I told Nick, maybe I need to put a sheet over my background or something, but he's like, no, don't do it. This is real life. Benzinga's real life, the anti-Wall Street. And I'm like, all right. This is what reality's like. We've got some dirty rooms, so I just let it go. And I'm hanging out in Detroit, Michigan, guys. You see somebody from Massachusetts, New York, DMV, Pennsylvania, Utah, Belgium. That might be the furthest. Another Michigander here, Texas, Vegas. What is Vegas like during COVID? I am curious to hear that one. Cleveland, Atlanta, Phoenix. Oh man. All right, it's going. It's going. We got people here, somebody from the UK, Miami. All right. Cool, guys. I mean, this is quite a wide spread that we have. Southern Spain. All right. I'd like to travel there maybe once we get a little more regular on the travel schedule. But all right, guys. But I'll stop blabbering on and hop into it. The one thing that I'm going to say is, this segment is all about you, right? We're not doing this for fun. We're doing this to be educational for you guys. We want you to learn tactics that you can use in the market starting bright and early Monday morning. Make sure you have your notepad. That's item number one. Item number two, make sure you let me know if you have any questions, right? I'm going to let Nick go, and Nick goes. And I mean, he does his thing. But if you have questions, I'll try to butt in and interrupt him and get some of those questions in there. So go ahead and drop them in the chat. I see one question coming in already. Is this being recorded? Yes, it is being recorded. So you can go back and rewatch this thing, but we're going to talk options, and Nick is the options guy. I mean, I learned options from Nick many years ago, and now I have the confidence to at least put on some of these trades. So Nick is the options guy. He is what I say, the options educator. And so with that, I think we're filled up. We got a couple hundred people. There you go, Nick. How do you like that intro?
Oh my gosh. I mean, I don't have any, bells and whistles. It's just down to earth, and you'll know why in a little bit. I looked at the places where you guys and girls are from, all over the place. I saw some French people in here. Bonsoir. I am French educated. I grew up in Beirut. So it's like we were a French colony until the 40s. We should have never left. All right, so we've got some options basics. Have been killing me. All right, so let's see if we can set you guys and girls straight on as far as options are concerned. So the idea today is to take it down and dumb it down, because I like dumb stuff for me. Plain, simple English, none of the jargon that you hear on Wall Street. We're not anti-Wall Street. I just would like to compete and win at their own game. And it is a rigged game. I'll put rigged in quotes, well-organized game. How about that? And we're at a disadvantage. All right. So I'm not going to talk a lot of Greek. I'm going to put it in plain, simple English. We're going to get a silver bullet. No, I grew up in Beirut, I told you, during the war. So this is the bulletproof. I can't get the Beirut out of me. So disclaimer is options are dangerous, but if you use them properly, in my opinion, they're less dangerous than regular stocks, but that's a bigger discussion. I'm an engineer who went into finance and climbed the corporate ranks of regular companies, and then decided I don't want to do any of this stuff. I just want to trade full time. You can find me on social media with at RacerNick on Twitter and StockTwits. And I contribute there, not as much as I used to, because I'm busy helping people like you. So this year has been crazy. We were just chatting about how crazy it was. For me, I've had to deal with some personal issues with my wife, and now she's getting better. So it's been a crazy year for everybody. COVID kind of like hit a reset button for everybody. And hopefully, like I heard that yesterday, we finally have one vaccine to be used in the US. Pfizer, I believe, was approved by the FDA after the panel said, yes, okay. The goals are simple today. Demystify options. And I encourage you to ask questions in there. I'm going to try to keep my eye on him. If not, I have backup. He's pretty good. Sometimes this, but
I'm on backup duty.
If we don't hear snoring, we're okay. So, and then I'm going to show you the plain simple concept, and which allows me to trade with confidence. Like if I do options and then I'm hoping, and I'm nervous, then I'm doing something wrong. I should have confidence. And that comes with having a good basket of tools. And one of which you're going to have to face it, it's technical analysis. And I'll tell you why in a little bit. But if you're ignoring technical analysis, Racer Nick, right here. If you ignore technical analysis, your opponent has a leg up. So what's a leg up? Meaning they have a tool that you don't, and you're saying, what opponent? I'm not playing a game. So if you don't think you have an opponent, you're mistaken. So when you buy a stock or an option, or sell a stock or an option, there's another person on the other end. You're not buying something off the shelf and putting it back on the shelf. There's a person or a machine on the other end that is thinks that you're wrong, as you think that they're wrong. And most likely, if it's a machine, you're definitely at a disadvantage because they are using all the tools that are in technical and such. So back to, where was I? Okay, so that is confidence. I want to get confidence. So before I do anything, I always start with this. So if you've heard me before, if you've seen my presentations before, they're pretty loose, but they always start with this formal one to define risk. And usually when I ask a question about, give me the definition of risk, and even if the room has thousands of people, I never get the one answer I'm looking for. Everybody has little bits and pieces and they have an idea. So I'm going to try to do it, and it's almost an aha moment, and it applies so well to options. Because it's all about it. It's a calculated risk. That's what it is. So what is risk other than the carrot? Everybody's got a carrot, whatever you want to do, the goal. But the risk itself, it has, in my opinion, two pieces. The first piece is the size, of course. That's what everybody says. How much can I lose? Yeah, that's part of the risk. It's a big part of the risk, but it's not the pivotal part of it. So it's basically, what is the consequence? If I take this bet, how much can I lose? If I buy the stock, how much can I lose? Of course, it's 100%. That's the answer when you buy a stock. And then the other one that nobody mentions in the way that I want it is risk position, which really translates into, what are the odds of me winning or losing? So that's the part that I like, because once I decide that I'm okay with the risk and I take the trade, how much? Once I decide that, okay, what is it? $100, $10,000, whatever the size of the risk, I'm okay losing it. That's why I'm risking it. So once I decide on that portion, this right here is the piece I manage. This one. I don't manage this one. I decided I'm okay with the risk size. Therefore, I'm in the position. The odds of me winning, that's the part I manage. When it comes to a point where my odds of winning I don't like anymore, or they don't fit my criteria of taking trades, I'm out, win or lose. That's how you manage risk, or that's how I manage risk, which means that there should be zero hope. So if the odds now are no longer favorable per my settings, and I don't get out, I'm stuck at hope. And hope doesn't pay the bills. Sometimes it works, sometimes it doesn't, but that's, like you said, Vegas, which you ask, how's Vegas these days? I bet it's quiet. It's probably nicer for the people that work there, except for the jobs. Poker principle, is that what it is? Yeah, I'm a pretty bad poker player. Well, I'm a not exciting poker player, because if I don't have a good hand, I just don't go in. I like to see how far am I from like the strongest possible hand and manage my bids that way. Hey, Pam. So the idea is to manage this part. You'd be successful. And if you don't have a set parameters or a method, then that also needs to change. Okay. So the other person that's asking, all right, okay, so there we go. I think I'm seeing some names I recognize in here. What are you doing here? You should go be out having fun. I do the work during the week. All right, so investing, I'm not going to go through this. Everybody knows buy and hold or you sell short, regular traditional investing. Let's just skip that. All right, so I didn't have time to refresh these. Usually I take fresh ones from like Friday or the day of. This I'm stealing from a different presentation I did not too long ago. On a day where Beyond Meat dropped 20%. So the idea is, why do we want to bother with options? You're probably already there in your head. That's why you're in here watching about options. But I'm telling you why you made the right decision. So on a day where you were short Beyond Meat, you made 20% in one day. But if you had done it via options, you made 300, 400%. So if you're new to investing, that sounds pretty attractive, right? But it's not very easy because the person that made the wrong bet lost pretty much everything overnight. So win or lose, it's the same. It's the percentage. Bigger bang for the buck. That's what I say here. Bigger bang for the buck when you use options. So once you make a bet using equities, like the regular stocks, you can win or lose, right? And if you make the same bet using options, you win or lose the same incident, but the bigger bang comes from the options bet. So if you do it properly. So that's why you can win big and you can lose big, but that's a big loss overnight, 20% of your money in a regular stock, right? So other examples would be, who is this? Facebook down 4% in one day. So somebody bet on the stock, they then shorted it, they made 4%. Somebody that used options, they made 40%. And the idea is current price, when it gets closer to the options I buy, those options that I buy explode in value. They become more expensive. For example, somebody that bought this contract the day before, they made $4 per contract, but each contract is 100. So it's like juiced. Okay, so now we're getting into weeds, and in a little bit, I'm probably going to break off of this and just jump into a trading platform. That's what usually ends up happening. I ditch you overhead and go into a trading platform. But let's go through, and I don't remember what we still have in here. Okay, so another method of me investing is by not just buying options. Once I'm comfortable knowing options, I should be able to sell them. I'm going to ask you all, you've probably seen another class on options. I bet you I didn't say what they said in their first paragraph. What? All right, I'm not going to wait. Most options expire worthless. Have you heard that one before? Probably yes. Quiet people today. Okay, there we go.
There it goes. There's all the guesses.
Talk about an awkward silence. Okay,
I know that a lot of my options expire worthless. That means I'm doing something wrong.
Christina disagrees. No, because she's good. That's why. Okay, so if that's the case, why do I want to buy them? So your goal would be to understand options and stay with us and migrate up the chain to start selling them, because then you become a micro market maker and you'd be selling hope rather than buying it. Let me state it in plain, simple English. It is much easier for me to find where a stock is not going than to try to pin where it is going. If I want to pin where it is going, I want to buy that option. But if I can tell you a million places where that stock is not going, and I go sell options there. Those are the ones that die worthless in my favor. So that's the idea. So on a bad day in a good stock, it is selling insurance. Thank you. On a bad day, my best opportunities come from a bad day in a good stock. I keep reverting to the same example because it just personifies this year. Perfect example. During the March debacle, AMD, great company. Nobody can deny that. They've done so much. It was falling fast. somewhere in the middle of the fall, I sold somebody insurance. I said, stop, I'll take your AMD stock off your hands for $20 or $22. And they paid me $2.20 for it per contract. So if I did 10, if I promised to buy 1,000 shares, I collected $2,200. Well, they didn't come even close to that price, but they panicked. And I was there. I did my homework. I looked at the chart and was like, whew, that would be a good deal. So I took it. I did it twice because I didn't nail the bottom, because after I did that, it fell more and I added to my position at $20. So anyway, if you get good enough, then you get comfortable, say, you know what, maybe I should sell some of the stuff. Now, I don't sell unless I know what I'm doing, because when I sell an option, I give up control. Like an insurance company, you buy an insurance on your car, then you're in control. You crash your car, they're out money. So same concept here. All right, so let's rip through and just jump in. This is another example of selling insurance. I'm just going to rip through these, and it locked up on me. Great. That's like 100% of the time now. We got to submit it. All right, so let's just jump into it. Back to this. This is an options platform right here. This is E-Trade. I'm not recommending it. It used to be better. Now it's less good. Okay, so what are we looking at? Netflix. We should use Netflix. Yeah, we can use Netflix. Why not? We'll go to January. Okay. I don't recommend, they have flaws. They all have flaws. This is a good options platform because I think it was built for options. It used to be Trade Monster. And now it lost some of its bells and whistles, but it's decent enough. I use Thinkorswim. It has excellent charting, and it's all free. You don't have to pay for bits and pieces. So try them out. They're all free to try. So this is an options chain, and I'm just going to jump in and let's talk calls and puts and all of that. So what you're looking at is a whole bunch of tabs, and I happen to click on January right there. That means this contract has 34 days. It ends somewhere in the middle of January, I believe the 15th in this case. And so it has a set number of days. It is a contract between a buyer and a seller. There are two flavors. You've got puts on this side, you've got calls on this side. Now, the counterintuitive thing is that when price goes up, it goes this way. Okay, look, price 455, 485, 530, price is going up. Okay, so how do we use options and what are they? Let's start with the put side. This one is easy to explain. All right, so if somebody owns Netflix and they want protection through January, they don't want to go through this Georgia debates or whatever in January unprotected. So what they can do is they can buy insurance. And what does that mean? They can go out and say, I want insurance at 455. Are there any takers? And so for that, they're willing to spend, they have to spend $7 per contract. So to protect themselves, they go like this. Okay, I have 100 shares. I only want one. And they go preview. Whoops. Is that going to err on us because the market is not open? Anyway, this is what the order look like. And it will cost them $7 times 100, because that's for 100 shares. So $700. And what does that mean once that's said and done? $700 leaves their account, the buyer, goes into the seller's account. So if I did my homework and I looked at 455 and I said, you know what? Yeah, I like it. So we were talking about Netflix. So let's go to Netflix. This is TradingView, by the way, if anybody's interested. This is pretty good. So let's see here. This is my chart with my notes. I look at 455. It's somewhere around here. You know what? Yeah, maybe I like it. So if I say that, this is not a recommendation to sell a 455 put in Netflix. This is just an example to explain it. I go out and say, okay, I'll sell you that. So that 700 leaves their account, goes into my account, but it's not mine yet. It's like collecting service. If you own a business, you collect the service and you haven't performed. You collect the money, you haven't performed the service. Same deal. I sold them insurance, but maybe I need to do something with that, right? So it's not mine to use yet. And if nothing happens, that $7 dies, goes to zero eventually as time ticks. Okay, and then I made $700 out of nothing. All I needed to do is to promise this person that I will buy the shares at $4.55. That's the put. The way to explain it is somebody needed protection, they bought it, they got protection. Because that's the put side. All right, so on the call side, it's similar, but it's a little harder to explain. So here's a good way of doing it. $500 a share, that's a lot of money to buy 100 shares, right? So there'll be 4 zeros. That's a big pile of cash. What if I wanted to lock my price low, close to here, because I think it's going to the moon in 30 days or 40 days or 1 year or 6 months? I can pick any one of those. Then to buy 100 shares, I would only have to buy 1 call and lock my price. In this case, I can lock my price at $5.15, or let's do a round number, $5.10, and pay $20 for that contract instead of locking up 50 grand to buy 100 shares. So what does that give me? It gives me the right. I locked my price. It gives me the right to buy those shares at that price between now and 34 days. And logically, I would need $20 rally to break even because I paid that money to be in that price. So I wanted to go $20 for me to start making money. That's the idea. Okay. So now we've got what a call is and what a put is. So the put, by definition, is basically reserving the right to the buyer to sell their shares at that price, even if it goes to zero. So if Netflix goes to zero, I bought the put. The person that bought the put owns the right to say, hey, buddy, you said you were going to buy them at $4.55. They're zero now. They're all yours at $4.55. Thank you very much. They have no choice. They have to pay $4.55. Okay. So they sold it. They have the obligation. The buyer is in control. Now, on the upside, on the call side, same deal. I reserved the right at $5.10. So let's say it goes to 600 for whatever reason. You can say, hey, you promised you would give me your shares at $5.10, or shares that hopefully they have. If not, they're short naked. That's a mistake. So then they have to deliver shares at $5.10, even though they're at 600. So for you, you just made the difference. Okay. So this is just what they function. It's the right to buy the shares at that price for a set period of time. So when I buy a call, I earn the right to buy those shares at that price. I could have chosen $5.10, $5.15, $5.20. I could have chosen January. I could have chosen next January 22, not this one, the one thereafter. Of course, they get more expensive, but it's still cheaper than buying shares outright. Okay, so this is the buying
Nic,
part.
do you mind if I pop in with a question real quick?
You can always pop in with a question.
Thank you, Nic. You're a very gracious host.
No.
But I've gotten a couple of people asking about stop losses and how you use them on options.
Okay, so I don't put automatic stop losses anywhere because I do watch the markets, and I don't believe in the stop losses that way. They do serve a purpose, but I would only say, hey, mess around with it and get to learn it exactly how it works, because I know some stop losses, the way it is, it's an order that's a stop loss order, but then if price hits it, it switches the order from being a stop loss order to an active order, and then it triggers on the next tick. So let's say we have a flash crash or a market, something broke in the market, that there might be some problems there. But it's up to you. I don't personally use them. What I use is I use charts like religiously, and if the chart tells me you need to get out, buddy, I get out. So, or you need to add, I'll add, or you need to buy, I'll buy. But it's pretty. I don't use automatic stuff.
And one other point of clarification I want to make really quickly. A couple of people have asked if you need to own the stock to trade options on it. You do not.
No, you do not. Options, you can buy them and sell them wherever. And this was my next step. So now I told you what use they have. One wants to protect, one wants to get in on the cheap or lock their price on the cheap. Yeah. So that's the use that they provide a function. That's what they have, a purpose. Now, there's a whole bunch of traders like me that actually use them to make money, the actual contract. Like somebody might buy this 5-10 call, not intending of buying the shares. They just think the price is going up. They don't want to lock up 50 grand. They'd lock up at 2,000. And then if price rallies, this price goes up. Look how more expensive it is the lower it goes inside. Okay. So if I pay 2,000 and Netflix rallies, then I make money immediately, because this 2,000 turns into 2,300, 2,400, and sometimes in minutes, and sometimes in overnight, and sometimes it drops in minutes. So you have to know. That's why I'm saying tools in the toolbox. Somebody just mentioned best charts to read. I don't know if you mean tickers or best tools on the charts. I can give you a little bit of that at the end. Okay, so there's another point, Chris. Hold that thought, okay? So there are some questions coming in. So I want to make the transition from the definition of them, which I just did, of the function, what function they provide. Now you can tell me I didn't speak a word of Greek. I didn't mention delta one time. I didn't mention theta, blah, 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 blah. I did mention theta indirectly by saying January and January of next year. Theta is a fancy word for time. Okay, so they all have a time. I started immediately by saying this contract has 34 days on it. And time ticks, they lose value. If the world stops and time ticks, they lose value if you buy them. Somebody just mentioned the in the money. Okay, so that's another term you need to learn, in the money. So you see how the color changes right here? That's where current price is, 503. It's between these two. So an in the money put is where the price has fallen below it. So all these are in the money. And in the money calls, these up here are in the money calls because price is past them already. It's 503. This call is 470. It's an in the money call. So an in the money call, the deeper it is in the money, the call I buy, the more expensive, clearly. But the more it behaves like the stock itself. So on a bad day, it's not going to lose as much. I had this very discussion with a couple of people in my group this week. One person says, how come my calls are down 40%? The delta is like 25. That doesn't compute. So I said, well, look below and see if you had bought a call that's in the money, you would be down like, I think it was 15%. That's because it's acting more like a stock. Up here, any call you buy up here, it has a bunch of hope priced into it. They call it extrinsic value. It's not intrinsic to the stock because the price hasn't reached it. It's all hope. Okay, so I learned all this stuff. I'm answering a question. I learned all this stuff on my own. I'll tell you the story how it started. It's pretty funny. But anyway, so the point is, an in the money call is a call where price is already moved up above it. So if I buy a 470 call, that's an in the money call. A 470 put is not in the money. These puts are in the money because price is already past them below it. See how the colors are the same here and not here? So these dark colors are hope. If you buy a put to short a stock, you hope it falls to make money. If it doesn't fall, you're going to lose your money. If you buy a call just to trade the call itself, you need a rally to win. Otherwise, you lose. Okay. So this is the idea of trading, the actual options themselves, and the terminology. So you've got the call and the put. Got calls for price moving up, puts for price moving down, and in the money means that it has price crossed it as far as a call, or has price fallen below it if it's a put. That's the in the money or out of the money. So the Greeks, you can talk about them. The theta is time. So they call it theta decay, just time ticking. It's basically when you buy a put or a call, you need price to go towards that put or a call. Otherwise, time is ticking and you're losing money. Okay, if you're the seller, time's your friend. That's why I like selling, because then time is working for me. And so you can do combination of things. You can buy and sell. So then we're talking about spreads, and we can talk about these in a little bit. All right. So somebody asked me, where did I learn this stuff? I learned it from by myself, and it all started from one friend. Years and years and years ago, I was running a company, and my friend stopped by. He goes, "Hey, I got to go to the bank. I want to take a lunch." I was like, "What are you doing?" He goes, "I need to go bring some money at margin call." I was like, "What did you do?" "I used to trade stocks only." And he said, I did something with a put, and now I need to bring in some money." I said, "What did you do?" He didn't know. He had no idea. All he knew is that he needed 25,000 to cover a margin call. So
that's a bad day.
Well, yeah. Well, he could afford it, luckily, at that time. But my point is, I got curious. Like, what's a put? Right? So I started reading. Back then, companies did not have options. It was just the indices and only a handful. And then they started adding them. And then we got 20 companies, the big 20s, and they were only monthlies. And some of them got weeklies. And now we have like 4 a week. This coming week, the SPX and the SPY have 4 contracts expiring. 1 on Monday, 1 on Wednesday, and 2 on Friday for the SPX, not the SPY. So there's a lot going on. And once somebody gets good and they can trade it for a living, that's all they need to do. Work 3 times a week. They call them 0 days to expiration trades. So, but you have to be good at it. So the easy way to make money with the options is to do a little bit of homework, use the charts, set your trade, and go fishing the rest of the time, or go do your job. All right. So somebody's talking about bid-ask spread. I'm going to give you a little tip here. I don't deal with stocks I don't look at bid. Look, you see a bid-ask column in here? I don't have them, because I only deal with tickers that I know are liquid, and it's not an issue. It's always going to be the middle between bid and ask. So if I go to buy something, it'll show you a bid and ask. I never read these. I know this is going to fill, if not plus or minus a few pennies, because I know my tickers. So last week I was reminded why I don't trade Lulu, because it's so hard to fill. So I said Alta, Lulu, Priceline, the old Priceline. I haven't tried Booking because of Priceline. So these are tickers that I just stay away from. They're money makers, but they're just, when I win, I can't profit as much as I want to. So I'm like, stay away from them. So bid and ask, always the middle should be, unless it's a not very liquid. What's a not liquid ticker? I don't know. Give me an obscure ticker. I can't think of any right now. You won't find thousands. You'll find like 2 or 3 or 10 tops, and you'll probably see only monthlies up here. So these will be tickers to stay away from. So recap, we've done the definition of puts and definition of calls and their function. One provides protection, one locks in a price. Now we also introduced the fact that you can use them to trade, buy and sell options. Okay. So the idea here, we're still talking just buying, and you can buy put options to bet down on a stock, to short a stock. Like if I think, I'll tell you what, I shorted NEO. Don't hate me. Okay, so I shorted NEO and Micron last week, made money on them. I closed my Micron. I did not close my NEO, but it's an easy couple $100 just to relieve the itch of shorting it big time, and just say, I did it, and I have a little bit of risk out to next March. How do I do it? I buy a put. And if price falls, I make money off the put. I did it with Micron twice this year. Not because it's a bad company, it's just purely price action. I promise you. I don't hate most of the companies out there. So that's how you would short a company. You buy a put. How do I go long a company? You buy a call. If I think, like Twitter, I just took a long Twitter because of something complicated I can explain on the chart a little bit later, and I have a thesis on it, and then I saw that they bought a company that's Zoom-like. I forgot what it's called. Anyway, Task or something like that. So the idea of it, finally, Twitter has 330 million users, monthly active users, and they can probably now collect money from the users. Nobody pays money on Twitter. I don't, and I'm on it all the time. An option, a put option, if I buy it, Nadeem, it's basically bearish. The only way I can make money if I buy a put is if a stock falls into my put or closer. It doesn't have to reach my put. It just needs to make a price move towards it within the time allotted. And in this case, I have 34 days. If I buy this, but let's say if I wanted to short Netflix with a finite amount of money, I'll spend $1,000 to buy one of these puts. And if the price drops a couple of notches, like $10, this 10 might turn into 13 or 14. Yes, that's the Twitter handle. So conversely, if I think Amazon, Netflix is going to rally, I would buy the call. And then if it does rally $10, that $18, $19 turns into like 23. But you have a time allotted, okay? So 34 days on this one. If I go shorter in time, you'll see. So next week is December. Look at the prices. They're so much lower because I have so little time. So here, if I do one, I'm risking $400. I need Netflix to make a good drop for me to start making money. But I don't need it to hit 487. I just need it to go boop. And then I can sell the put I bought back and collect some money that way. And that's basically just trading the options. So what is better? I like more time because then every red tick doesn't freak me out. So some people like these because they're lottery tickets. And if they have a good mojo on the charts and they're good with their charts, these are the way to go. But boy, you better be an active trader there. All right, so now we talked simple. These are called legs, by the way. Each one of these is a leg, an option. Now we're talking Wall Street terms, legs, okay? And there's something called spreads. Okay, so warrants, somebody's asking, I'll address it now because I bet you were talking Palantir, right? Or no, Workhorse? Workhorse? Yeah, one of these two. I think it's Workhorse. Okay, so a warrant is different than an option. An option has a time limit. I think a warrant is a do it or not. So Workhorse has millions of warrants out there, and they have an exercise price of $11.50 or $11.75. I can't remember what it is. So, and they have a deadline by which time they say, okay, all my warrants, I want to convert the stock at that price. If not, then the warrant is worthless, basically like a fraction of a penny. So the warrant is something where, like, if you were pre-IPO and jump into, or trying to do a financing deal on the side, like what's his name did with Goldman Sachs when they needed money, Warren Buffett. So the option is a contract that has a time limit between a buyer and the seller, plain and simple. The warrant has financing issues behind it, I think, and other things. They're not the same. So is that QS, QuantumScape? We can talk about it later if we have time. Or yeah, we can talk about it later. So let's finish here. So now we talked single legs. Okay, so I want to introduce you to the concept of spreads because of, especially if you're looking at high tickers like Netflix or Tesla. So let's go to Tesla, everybody's favorite stock. Next week, by the way, do your homework on Tesla. And it could threaten the whole market the way it's going to roll into the indices. So with quadruple witching and all of that. So I'm going to go to January to avoid all of this. So this is a January contract, 34 days. for Tesla. It is $610. It had a bad day, but that's all right. So if I wanted to short it for whatever reason, I'd have to spend $4,000 per contract if I wanted to just buy one contract. Okay, so it's quite a daunting amount for only 34 days. It is better than shorting it outright. So just so you know, I don't know if you know that, how to short a stock. What's the concept of shorting a stock? The concept of shorting a stock is when I sell it and I don't own it. I'm basically put in an order to sell 100 shares and I don't own any shares. And the platform will let me do it if I have a big enough account, because in fact, the position in my account will show short 100 Tesla. And what in effect happens, I am borrowing shares from somebody and then selling them right away. So if I'm bearish Tesla and I think it's going to fall, I'll borrow them now and sell them. I'll collect $610. If I'm right, Tesla falls, all I have to do is return 100 shares. I don't have to return $600 worth of 100 shares. I buy them at whatever fallen price is. So if it falls to 550, I'll buy them back for 550 and return my shares to close the position. Meanwhile, I collected 610. I bought them back at 550. That's the money I made. So how can you lose? I can lose unlimited amounts of money, because as long as it's rallying, I need to return 100 shares for which I only collected $610. If it goes to 700, I lost $90 per share. And the difference is the losses are unlimited until I close my position. You don't actually have to borrow from anybody, Christina. It just shows up in the platform. But you need to have money. Not everybody can just short a stock. And I never short a stock like this. I never short a stock like this. Capiche? Never. Okay? So this is where unlimited losses. When you buy a share, you can only lose your money, not your money and then some. All right. So the idea is, how can I mitigate this purchase of the contract, whether calls or puts? It's so expensive. I can do a spread. And this is a vertical spread. Look at it. It's vertical, up, down. Same contract. So I can, instead of just buying one and costing me $35, in this case, it's going to cost me more because I was thinking about the higher one. Let's go with the 550. It's $39. Instead of buying the 550, I'm going to buy the 550, but I'm going to also sell the one below it, or two below it, 540. And I'll show you what it looks like. So instead of buying the 550 put all by itself, this green one, I would buy it and sell one below it. So now my entry cost is only $4. So why would I want to do that? Well, first of all, I spent $400 on one contract. That's $400 versus $3,800 to buy one leg. It's not risk. That's the opportunity, Tony. So I'm selling. I'm buying the spread, buying the higher one, selling it. So let's go through the definition of the put again to understand this, okay? Me buying this reserves me the right. I'm not at risk. All I'm risking is $3,800, okay? Me selling this gives me $3,400, $3,500, but now I relinquish my right below that level. So this one, say I'm making money, I stop making money. Okay, so I'm making money, I stop making money. And that's the disadvantage, that I have a maximum amount of money. Let's see how bad that is. I paid $400. I could make $600. That's more double than my money. How bad is that? Huh? That's not bad. That's not bad at all. I more than doubled my money if I'm right. Are you kidding me? Sure, I could have made a ton more if I just bought it naked. But who's got the gonads to spend $4,000 for one contract to short Tesla? One bad day, one good day for Tesla will cut this amount in half. So if you can stomach losing $2,000 on one good tick, naked is the way to go. Spreads is the way to go if you're more conservative. If you have good conviction, like if you know something that nobody doesn't, or if you're a really good harmonic trader, like you can chart, those guys are freaking amazing. So you can take bets like these. Otherwise, yes, the maximum profit is $10 because it's $10 wide. Look, 550 to 540. However, I paid for. So my maximum quote profit is 6. So what if I go lower? I can go lower. Look, the amount drops. I like to pay about $3. And we'll come into it in a little bit. So yeah, I need a bigger drop, but depends on the time, depends on the chart. This is probably a more of a lottery ticket than an actual trade. Okay, so let's save this order. Let's see if it saves to revert to it later. All right, so this is a spread, a vertical spread. If you want to name it correctly, it is vertical. What kind of spread? Put spread, because we're talking puts. By the way, I can buy it in the money. Copy and go up. I can buy it up here. Well, that's wrong. Okay, now we're up to $20. So it jumped to $20. Let's move it to here. There we go. Now we fixed it. So why would I want to do that? So now it's cost $6.30. No, it's not a bull put, Tony. This is, we're buying it. It's a vertical, bearish, regular spread, put spread. I'll tell you what the bull put spread is in a second. So the question is, this is a vertical put spread, not bull put spread. It's exactly the opposite of a bull put spread. So this is a bearish vertical put spread. So if I buy it in the money versus down here, it costs a lot more. So now I'm paying $600, but the maximum is still 10. So I can still make roughly $400 to round. So the difference is time is on my side now because I don't need it to drop. All I need is time because it's already in the money because Tesla is already under 630. So if time expires right now, I win, and this 630 turns into 10. I paid 630, I made $400. Okay, so now it's in time is on my side. I need it not to rally, and all I need is time to tick, and I win. Versus if I go lower, I need a drop, and if time ticks and they draw and the time expires, I lose my $4. Okay, so that's the difference of where I buy it. Most people buy them here. Okay, so if I buy them close to the money right here, it should cost about half the spread, about $5. See? So now we're going to speak Greek for a second. You've heard delta, right? The delta is the coin flip, right? What are the odds of that coin flip coming up? So guess what a delta is right here? About 40 or 50. It's a coin flip, 40, 50, whether a put over whether a spread. It's the same, 40, 50. Look, this is the delta column right there. So think about the delta as your odds of success. The lower it is, the lower the odds of success. Look, I go away from current price. It drops to 20, 25. So here, I only have a 25% chance that price is going to go to it, right? Roughly speaking. If here, it's a coin flip. It can go below it. It can go above it, just like buying a stock. Coin flip. Go below it, go above it. Down here, oh, I need it to go down there, and my odds are pretty low. Same up here. If I buy the call here, coin flip. It's like buying the stock. It can go up and it can go down. If I go up, they're dropping. The delta is dropping. If I go higher to 650. Where are we? Now it's in the 20s, in the 650. I don't worry about how it's calculated. So if you want to learn that part and come teach it to me, that'd be great, Bart. I don't know how they're calculating that. All I know is the options are priced and the machines are trading over it. And that's how they price the VIX off of that too. So a high VIX correlates with extremely high values here. Let me share that concept with you because sometimes it befuddles people. How come they get the price move they want, but they're not seeing as much profit? Let's say you buy a call and the price moves in your favor, but it's a really high day for the market and the VIX is crashing. So some of that call value premium that you bought is eroding away with the VIX dropping. So the VIX goes pew, and it depresses the prices of all options, including the call that you have. So for a little period of time, you'll see some premiums suck, some profits disappear just because the VIX is dropping. Conversely, on a bad day in the market, if you go buy your puts for protection, everything is over expensive. The worst time to buy options is on a bad day. It's like calling the insurance company when your block is already starting to burn. Guess what? They're not going to sell you that insurance, and if they do, they want to make you pay for it. Is volatility a benefit for options trading? Only if you're a seller, because you're collecting. Otherwise, you're overpaying. Volatility means high VIX, means high implied volatility. Look how nervous investors are for Tesla. 90. That's the implied volatility. So that's how nervous they are. How nervous is that? Let's switch tickers. Apple. 30s. People are more comfortable trading Apple. Okay. Let's pick a wild one. Snow. 80, 90. Zoom. You see my drift? I call these momos. Oh, it's dropped. It's eased. Not the price. Doesn't matter its price, just how violent they are. Okay, so CMG. Wow, that's pretty tame now. That used to be a big Momo stock. So those values matter. The implied volatility, anytime it's high, it's bad for the buyer because you have to buy them expensive. You're paying a premium for no reason. Just because there's a bad day in the market, you go to buy puts in Tesla and you're just going to overpay. So the worst time to buy puts is when the drop is happening on big days. Like if you see it happening and you are technically savvy and you say, oh, this is just the beginning, okay. But if you're buying when the market has already dropped 3%, this is where you need technical knowledge, basic technical knowledge. And by the way, if you join the group, all of my trades come with videos. And the videos, if you just follow the video, you can learn technical analysis in plain, simple English. You'll get the idea, or you will get enough information for you to hunt the idea down. No, not at all. You cannot make time go faster. Somebody's asking, is high volume or high volatility a quicker time erosion? Absolutely not. Time erodes the same. It means that the stock chart moves faster. So the options are going to explode. That's what the market expects. Okay. Speaking of expectations, now the money maker. Wait, stop everything. Pay attention. The money maker is you have to know the sandbox. Where do the market maker think prices are going to go? Okay, so this is what makes or break a strategy. I'll tell you why. You go to Vegas, the house wins, right? Okay, there's a house here and you ain't it. So you're the person walking around Vegas floors or Macau. Is Macau open again? I don't know. So why are you giving away the product so cheap? Okay, so here's the deal. There's always an amount. You've heard it on CNBC if you watch CNBC. They say the stock is expected to move plus or minus X%. You're saying to yourself, how the heck do they know that? I'm going to give you a tip. I'm going to tell you how. This is an easy way of doing it. They have a complicated formula for it, right? So there's the cost, add up the cost of the put and the cost of the call at the same place, and that's the expectations. So in this case, it's expected to move almost $140, $135. So, but according to what the pricing is right now, based on what I'm looking at here, this stock is expected to move plus or minus $135 in the next 34 days. not more, not less. So if I'm buying a put and I buy it lower than 130, I'm making a mistake because odds are it's not going there. So if I wanted a realistic put, I want to be just above that 130, which puts me in this range right here. That's why I said I like this delta number for a lottery ticket. Okay, so if I buy them here, then I'm good. I don't need to know that what's the price going to move up or down. It doesn't matter because I'm right there. I'll start capturing. So this is the idea that everybody misses. When you make a bet and you put it in a place where it has no chance of winning or very little chance of winning, and then it becomes a lottery ticket, literally. Okay, so now if you want to sell stuff, when you start good at being good at it and you start selling options or option spreads, then you want to sell outside that 130 because you want to sell insurance to a person who doesn't drive, or they drive out in the desert, not downtown. Well, now I used to say downtown New York, but I'm pretty sure it's not as busy now. I don't know, downtown Beijing, that's probably busy. So this is the concept. Know the sandbox. You have to know it. Otherwise, where do you place your risk? Okay, so the $130 comes from buying. See, you weren't paying attention. I even yelled, gosh. No, just kidding. So add the price of the put and the price of the call at the same place. Are you here trying to make me feel bad about me saying that options are a lottery ticket? You think buying a stock is not a lottery ticket? Then you've got something else coming to you. Okay, so
I've learned that one from experience. Yes.
Yeah,
it's all about being strategic with those tickets.
Right. So yeah, what the first word I said, it's a calculated risk, right? Same as a lottery ticket. You calculate your odds, 1 in 3 zillions, or here, 85%. I like 85% lottery tickets. I'll do those all day. Okay. So yeah, somebody's trying to make a point. Take that person's name down. No, I'm just kidding. Their point, they make a valid point. Okay, so if you use it willy-nilly, it's pure gambling. That's what I said, right? You need a method. So if I could, sorry about the noise. My son has a race truck and he's working on it today of all days. So hopefully you can't hear it. So you can do homework and do it properly and reduce the lottery. The ones I call lottery, it's that are low price and low odds of success, but you can place them in a spot that it's realistic enough to where it's not just like a lottery 1 in a bazillion, but it's 85% chance of success or 30% chance of success, which is pretty good for a pure lottery ticket. All right. And sometimes they pay big. So poker strategy. Well, yeah, if you're a good poker player, then you know the parameters. And I'll tell you how you get good. Okay, so we just talked. What was the stock you and I talked offline, Luke?
Gosh.
You gave me a ticker.
Tesla?
You said you said you're really excited about it. Let me see if I do it different.
Oh, my Neo? Oh, no, my New York Times. There we go.
This one.
NYT.
Okay,
there we go.
So just before you joined us, we were shooting the breeze, making you wait to be fashionably late. I was like, why are we waiting? No, I'm just kidding. So here.
I did say I like to start 1 minute late. I did say that, okay?
Right.
So if you guys waited an extra minute, I apologize.
I threw him under the bus. All right, so he gave me a ticker. He said, I'm really excited about New York Times. I promise you, I've never looked at the stock before. Okay, so Saeed, I'll tell you that in a minute. So Saeed goes for the throat right away. What's your reason? Okay, so I know nothing about this stock, and I am self-taught when it comes to technical analysis, and I have to pat myself on the back because I'm freaking amazed at how good I pick numbers on the chart. Not because I'm a genius, because I'm thinking like a machine would think, and the machines are doing 90% of the trading, so they tell me. So it's totally predictable to a degree. So he says that they had a headline here. So I looked at the chart and I said I would have bought this on the 4th here. The day they cross this tick right here, this would have ding on my computer and saying alert, because I do homework, and I'll show you in a second. And that would be the breakout. So this is like an expanding range. They say buy the third touch. So if you know your stuff, somebody should have bought it right here, because it's an expanding range, and they say buy the third touch of it. That's 1, 2, buy the third one. You get to ride it all the way up to here and then ride the breakout. So if I didn't buy it here, I would buy it here. So I would sell it here, kind of try to sell it with a tight stop. This one would have lost, but those are the concepts. So you have to be good to improve your performance. And I would not just buy something I don't track. So let me see, is this it? Yeah. So I do homework and I set a lot of alerts, and then they come into my email box. So these are from this week. I got one from NVIDIA, Lulu, Sarepta, that looked good. Splunk. Splunk is to catch a falling knife. I didn't bite on it yet, probably soon. MasterCard, credit put spread, these are bullish. So they must have been falling into support, and I haven't done my section yet. So tomorrow I'll go through these alerts and I'll say, Walmart, okay, do I want to catch a falling knife? I like it because it's falling into support. It's a zone. It's not a hard line in the sand. So I triggered one alert. What does this alert say? Credit put spread 2. See it right there in the notes? So these are notes to myself that I did during homework. Okay, so if the markets don't crash, this is a place where I'd like to catch Walmart, because it's probably going to swing back up and then tackle this box up here. So that's the kind of trading. So when I see it coming down here, I sell put spreads down here. And if it goes there or not, I don't care. The put spread survives, I make money. So that's how is the idea of trading. Now, if you want to get started by buying stuff, then you have to get better at pinning closer to a bottom. And in this case, if I'm committing long-term, this should be a good trade on call options as well. A debit call options or a call spread or a debit call naked. I prefer spreads because it's cheaper. I still can double my money. I have better conviction because I'm not sweating every red tick in the stock. Okay, so you have to have a method. So part of my presentation, you can't see it now because it crashed on me, is the fact that there is a method to it. And if you don't follow a method, whatever that method is, then you get to trip. Okay, so the write-ups I do have usually a macro. Let's see, I did take a picture of it. There it is. So first of all, I write them up. They're pretty messy, and the team is so awesome at putting it all together to look like this. It's in sequence. These are behind each other. I just pasted them to make them look. So we have a naked call entry. The alternative trade is a call spread entry with the green and the red picture. The macro, like the overall, you can't trade a stock without knowing how the whole world is trading. Like it's not going to rally all by itself. The micro, what do I think of it? The thesis, why am I taking this trade, blah, blah, blah. And a video, where is it? Oh, video explanation right there, walking through the whole thing. Okay, so thanks, Sylvester. So in this case, let me see. This is one, stamps.com. When I entered the trade, the open base price is 176.5. What is it today? Oh, 199. So I opened the trade somewhere around here between these two ticks. So this one is good. However, check this out. This one is going to probably get better. All right, so it fell. That's why I did homework. It fell into support. But the exciting part, if it does this and then comes back to here and reattacks the place where it just failed, and they go above it, they test it for support, then it goes like this. Do you know this looks like a cup and handle? That's what they call it on Wall Street. I call it, it's a neckline that failed. And the calculation of the rally size is about this much. For me, if it rallies, it's going to find some sellers here and definite sellers there. What is this? This would be my exit point anywhere in this zone, right? So that's the trade there. Why do I think this would hold? Look left. I told you machines are trading, right? Cluster, base for this whole thing. You think when they come back to it, they're not going to try to hold it first? They will. That's support. That's how you get support lines. Okay, so homework leads to trades. I should have brought the report. I recently shared via email. I forgot how much it was. But anyway, we win more than we lose. How about that, Saeed? You asked. What? I've been doing this with Benzinga since 2012. This one here, we're looking at 1 day. But I usually start at a day, drill down to 2 hours. Look, it looks more clearer on the 2 hour, that cup and handle that I just shared with you, right? I don't want to turn it into a technical, but I'm going to share to you what goes on in my mind. I used to be more fundamental, and now if you give me, you can read fundamentals or you can read charts. I'll say you can keep the fundamentals and I'll keep the charts. I bet you I beat you every time. I beat myself every time. How about that? Cup and handle, this much, that much. This is a cluster that's going to be difficult. This is going to be some battles over here. Look at my charts. I don't have a lot of lines. All these are hand-drawn. Yes, there are a lot of lines, but they're hand-drawn. They're homework. Okay, I'll tell you my tools. First tool, can anybody guess?
Charts.
Well, on the charts.
No.
First tool on the charts. No, tool to find the support. Okay, I'll say it. Eyeballs, yes, Pamela, closest. Eyeballs. Look left, eyeballs. So the eyeballs allow me to see the levels. You can see them. Just zoom out, take your hand off of the mouse and the keyboard and look at it. It's right there. They're like, watch. You want to pick another ticker after this, we'll do it. Watch this. These are not coincidences that this was a support, it was lost, and now they're going to have a hard time with it, and now it's my neckline. If I go left, look, it was the base for this whole rally. It was resistance, they fell, they came back, fought over it, to go over it, test it for footing, and then go. Look, over and over. So now I found a level. That's eyeballs. I'm blind. I'm sorry.
Nic, real quick
you know
question.
What? Wait. Ted says he's blind. So I thought about this the other day because I just had eye surgery this year. I was like, oh my gosh, do they make chart braille of sorts? Because I need to do it. So that brings up a good question. But anyway, finding levels on the chart. If I can't see, I have a couple of technicians that I can trust. You can call me, Ted. I can hook you up with the levels. Okay, you were saying?
Yeah. Just real quick question. What interval are the candles on your chart, and how far back do you look?
Okay, this is 1 day. And if I don't know a chart, I'll go to a day and go a year. So if you're on TradingView and you go 1D, takes you to a daily, and you hit Alt-R, it'll reset to, or if you click this one down here, 1 year, 1 day, and it gives you 1 year. So now we're looking at 1 year. But right here, I need to get more granular to see what's going on. I'll go 120. So now I'm looking here on hit reset, and then I'll move it a little bit to see it. Okay, so now if this doesn't give me enough information, I'll go to 60. Doesn't give me any information. So if I'm actively trading, this is a bad chart for that. Let's go to Apple. If I'm actively trading, this is still 1 hour charts. Every candle is 1 hour. I go to 15 minutes. Now I have actionable item. So now if somebody calls me, hey, I'm looking to sell Apple, trade Apple intraday, that would be the level I would be looking at, 5, 15, 30. And here, like if it's here and somebody says, I'm going to buy calls, and I say, no, wait, you buy calls above 124 or you fade it and you buy the calls when it comes back down. So if Apple loses this, it's going to 118.5. Yeah, this is tradingview.com. They're pretty good. You have a text note down here. You can write code if you want to. I don't go through the other ones. They have a base free version. I don't know. I think it's $15 to get this stuff here, the volume profile. This really important stuff, by the way. Volume bar. So number one tool is eyeballs. Sorry, Ted. The number two tool, Galano Consulting. Okay, so the number 2 tool is that I have is volume profile. So what is that? I'll tell you. Volume bars are down here, right? They tell me when the trades happened. It's not very useful. Volume bars here, the same information. They tell me at what level they happened. That's more information. So now it tells me that up here in this inside this whole cluster, the busiest spot is 115.2-ish. 115, that's around. This is where buyers and sellers agree the most. So if it falls into 115, it's going to find support, because by definition, that's where they love to trade it the most. They're going to be, when a stock is falling, they're more sellers than buyers. So it's sell, 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 buy, sell, 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 buy. Falls into a place where they both love it, buy, sell, buy, sell, buy, sell. So no longer misaligned, and it finds support. So in this case, you can see that Apple is going to have a move soon. How do I know that? Guaranteed move coming. I don't know which way, but I'm guarantee you action. Okay, so you got higher lows knocking on the roof. So price went from going like this, dunk, 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 it's going to go boom or bam. I'm okay with either. I'll chase it or I'll buy the dip closer to here. In fact, that's how we do homework. Check it out. Chase it. Oh, that's a big scary thing up here. So gonna have to be quick with it. The bulls are they're gonna need a headline help to burst through this. Okay, so you manage the time for me. I don't know what we're doing with time, so I can go all day. Actually, I can't.
We're getting close to the end.
Okay, so I have a honey-do list a mile long. So back to the point of options. Okay, so they're a great way of adding to your trades. Whether you're a purist of stock and you don't use options, you're really shutting off methods of protecting your shares. Okay, so here GE was a trade I did for the group. So it was buying a $7 call way back then for next year. Paid 80 cents for it. It is now $4.22. So if you did 5, you made $1,800 out of 80 cents, 400. But I know it was higher than this. I did the same thing with Ford and a couple of other stocks that were big home runs. Uber, Etsy. DraftKings. That was a big winner. Woo, man, that was good. The Qs worked for a little bit and not. The W worked for a little bit and not. Citigroup was a big hit. We bought it at 45.5. Now it's 59. So somebody asked about the record. I'm just walking through. CRM was not so good, but it was a lottery ticket going in. I said overnight risk from earnings, big letters, right? So then came out the news that yes, they're buying whatever company. So I sold put spreads and that made my money back. So I'm even personally with it, but active trading stuff that I can't share quickly like that. Let's see here. Stamp was a winner. Etsy was a QUC, GE, Uber, Q's won. Disney. Oh my gosh. Okay, so wow. Okay, so Disney trade I shared in June, paid $5 for the premium. It's now $46. It's a January 15th, so it expires. It's we bought the 130. Disney. I should have kept it. I should take my own advice. No, wait, call. Wait, no, call. Yeah, right here. I'm so used to doing puts. Look, it's right there. So 40, let's go see it in the account. I forgot about that. Okay, so if I paid for $5.10, it's $500 to open the trade. It's now $4,000 for one contract. Okay, they're not all like this. Disney is a special case. GE was a special case, I guess. Ford, Citigroup we bought. I shared the 50 and the 4750 for 2 different time frames. The 50 for, okay, so this is where we get to see time travel. Citigroup. I had it in 2 flavor, one for January and I believe one for March. I'm going to share fewer. Where is it? Yep, March. Okay, so the 50 call for January, $9.50. When I sent it out, it cost $1.1, and now it's $9. So one contract is now 9 times basically. And the other one was 4750. It's now 12. At the time I shared it, it was $3.95. Now it's 12.35. So if you get it right, you win big. And in this case, I risked $100 for one contract. If I did one, if I did 10, $1,000, but then I made 9,000. And now it's 9.7 something thousand. And here I spent a little more. So one contract cost, what did I say, $395. So let's round up to the 400, and now it's 1,200 and change, $1,235. So that's the way why it's exciting to do just naked calls. Well, I can handle a cost of $1 or $3 for a premium, but when you're talking big ticket items like Tesla and Netflix, those dollars are not there. If you go for the same contract, $6,900 for one, right? So that's where spreads make sense. Okay. Twitter, I just recently went long, and I had a thesis, and I don't have a specific reason to trade. By the way, I say, learn this. Here's a tip for you. No, not now, Disney. Anyway, I'll leave you be. So the idea is no trigger, no trade. If you don't have a reason to do something, don't do it. And the way I stop myself is I ask myself, would I take my mother's money who's 90 and do it with that? This brings me, no. Then I shouldn't do it for myself either. Sometimes I take crazy money, real lottery money, and I do it. So Twitter, I like it for a lot of reasons. I'm going to go to a monthly chart and reset and put my lines back in there. All right. So this is a place where it's been battling for 5 years. This is 5 years, for 2014. And I did this with Snapchat, and it just was a huge winner. In this case, I did it for fundamental reasons, which I never do. I hate Twitter from the fundamental reason because they don't make money on anything. They don't have pay-per-clicks. They don't have anything. So let's assume that this new venture that they bought is, in my opinion, is a tangible way for them to actually collect money per user. So imagine if they actually collect $1 per user. That's $330 million down to the bottom line. So I don't know how that's going to work out, but I bought it into next year. I didn't even bother. I said, I'm going to take a lottery ticket out to next year. So somebody's going to say, well, you admit it's a lottery ticket. Well, if you buy the stock up here, aren't you admitting that it's going to be higher next year? I'm admitting with less money. So who's more gambler? I'm admitting with less money. So yes, you get a stock that you can hold forever. Maybe it turns into toilet paper. Maybe it doesn't. But I'm willing to spend less, which you could probably lose. And we'd be the same, taking the same bet, 2 different methods. Don't knock the method. They both have a job to do. Here's another job to do. Once you get good at as options, why do you need options? You can create your own dividends. Twitter does not pay a dividend. How about you paying yourself a dividend? What? Yeah, you can. So here's Twitter. If you don't think it's going above 80 by next March, or if you don't think it's going above, that's too short, not enough excitement, 70 by February, then for every 100 shares, you can collect $100 out of nowhere. So you say, well, $100. Well, $100, it's a yield on the $50 stock price, right? That's 2% air math. So who pays 2%? Apple pays maybe 2% yield. You're getting paid 2% for 2 months if you do this. So anyway, you can sell covered options, covered calls against stock you own or calls you own. So if I own a call out, like I bought a call, I forget which one I bought. Anyway, 70. I think I bought the 70, June or July. I think. Maybe I paid 350, I think, of 350, 340, 312. Now the number comes into mind. So it's already green, by the way, but now I own the 70 call. Now I can sell against it. So I can sell the February 70 call against it. And if Twitter does not go above 70 by middle of February, then this money dies in my favor. So in essence, I would have gotten this one for $1, 1.2 lower because I collected one over there. So covered calls, you can do that by owning shares or owning calls that are lower than the calls you're selling.
All right, so, Nic.
Yep.
You've been doing your job, which is educating and giving trade ideas. I'm gonna have to step in and do my job now. Yeah. And guys, I wouldn't let you out of this one if I didn't talk about how you can keep in touch with Nic on a go forward basis. I'm going to go ahead and drop a link and a coupon code in the chat here. But guys, if you want actual trade ideas from Nic, if you want to keep the education going, go ahead and click that link that I dropped into the chat for just $67 a year. Again, Nic always yells at me for this pricing, but whatever, we did it anyways. The landing page is set up, the coupon is set up, but for $67 a year, that is less than your Netflix. You can get 2 of Nic's trade ideas every single month. Along with some of his videos, ongoing education, etc. It's not just giving you the trades, but actually, we want to teach you how to do this. That way you can do it yourselves in the market. I mean, I learned options from Nic years and years ago. You heard he said he started with Benzinga in 2012. I started with Benzinga in 2013 and have been following Nic ever since then. So seriously, guys, check it out. Yeah, the pricing, so Sylvester's saying it's incredible. Yes, it definitely is.
Sylvester is like my biggest fan.
Yeah, I love Sylvester. Sylvester's great. And guys, if you're a little bit more active than that and you want more than 2 trades a month, after you get through that first checkout page, there's going to be a second page that lets you add an additional 4 trades. So you're getting 6 trades a month plus more education. That's what I recommend. That's what I use. So go ahead and go through that first checkout page and then do the second one. And I got one more thing. So if the pricing isn't low enough, something even better is that unlike markets, this is risk-free. You can never take all the risk out of trading, but with this, we do have a 14-day, money back, no questions asked policy. Right. So if you like Nic today, you hang out with him for a week, you don't like him anymore, you say, Nic, I'm done with you. Just shoot us an email and we'll refund you back. But again, guys, for just $300 a year, that's like $28 a month or something like that. You get 6 real trade ideas. You get the ongoing education, and you become part of the community, right? You can always email me, luke@benzinga.com, with questions, and I can help you walk through the trades. Sometimes I don't know the answers, so I forward the emails over to Nic, and he helps me out with the answers. But again, if you want to learn options, you want to be a better trader, you want to figure this stuff out, don't do it by yourself. Nic did it by himself and somehow figured it out. I didn't do it by myself. I did it with Nic. I did it with the community. I took his ideas. I started using them, learning from them, etc. So again, code options30. You get just $67 a year for that first tier. $300 a year if you want 6 ideas a month. Again, super cheap, guys. Nic yells at me for the pricing, so maybe next time we do this, we'll have to raise it up so I don't get yelled at in the pre-webinar hangout. And again, I'll drop that. Is there a time limit to using the coupon? Yes, the coupon does expire tonight. I believe at midnight ET. It might be a little bit before that. I'm not totally sure. Dropping it in the chat again there. And Nic, well, I've been blabbering on it. I see you're doing something interesting on this chart here.
Yeah, somebody asked me about Dash and Airbnb. So I did Dash. It was a number 146, I think, was an interesting. This is an interesting candle here. This one right there. So I would keep an eye on like 182, 181 and change. Keep that in mind. See what happens if they get there. You want to maintain higher lows. If this is the prospective path, hopefully there's going to be a battle here, 180. So the first challenge is 180. If they get to and above 182, they can make some headway, but then they have a lot of supply up here. So I don't know anything about the fundamentals of these guys. So I can imagine that having a vaccine might help them a little bit. Both, maybe less so DoorDash. Actually, they're maybe opposed on that one. So I would, I don't know the fundamentals of either. And don't trade Uber like a DoorDash, please. They're completely separate, different company.
Cool. And let me hop back in really quick. I'm getting a couple questions in the private chat about what exactly the product entails. So let me explain it a little bit better. So we're just the $67 per year, twice a month. You're going to get a trade, an options trade from Nic. With a write-up and a video, right? Explaining the trade, why you put it on, how it works, how you make money from this trade, and that sort of thing. So you get the trade and the research done for you, but then again, you also get that education so that way you can start doing this yourself.
Can I stop you right there for a second?
Yes.
If you guys and girls want to do yourselves a favor, at least go to the middle one.
Yes.
Twice a month is not frequent enough because I think my best contribution is not the actual trade alerts, but the method. You'll see once a week at least if you get to the middle one, 3 a week if you get to the top end one. And there's no risk because these guys will give you your money back. So basically, right? Isn't that a guarantee of sorts?
Yep, yeah, exactly. That's why I like to say, unlike markets, it is risk-free to try it.
Right, yeah. But my point is, if you see it every week, you're going to learn the method. And the videos are really good. I pour my heart and soul into the videos because I would want somebody to explain it to me like this. And I speak to a lot of people on a day-to-day basis. So I'm accountable to these. I'm not a trade alert service. I think I'm an educator because I don't know what's going to happen with price. Not everything wins clearly, but the method is solid. I give it thought and I construct it. This should be what you do on your own, however you trade. You should have a macro general idea, reason why you went into the micro, you know the company inside and out, reason why we went into the trade. I put it in the video to explain it. And then your method, whether you buy stocks, sell stocks, you buy calls, you sell calls, you buy call spreads, put spreads, or you sell puts and calls and all of that. So it doesn't matter. The method is the same. The process is the same. The actual implementation method may differ.
Yeah, and that's a good point, Nic. And that 30% off for today does apply to the second and third level. I personally use the middle one. I know Nic's like, what the hell? Stop.
No, I'm fine. I kid when I give you a hard time on that. I don't know marketing. You guys know marketing, so
yeah, I hope. But again, the middle tier.
I'm gonna bow out of here. I'm causing more ruckus. I appreciate your time in here. Can you take it over from here, or you still need me?
No, I can take it over.
I just got to make sure my son doesn't burn down the house. He's got
yes. Go take care of your son.
Plasma cutter in one hand and a 220-volt welder in the other.
Yeah, there you go.
Do I know about that stuff?
But yeah, guys, like Nic was saying, I use that middle level, but because the twice a month isn't frequent enough for me. I do the 6 a month and follow Nic into his trades there. I see a couple of people in the chat talking about they use the highest level where you're getting 2 a week. I mean, if you really want to educate yourself and level up, I mean, that's the way to do it, because that is just so much education. So again, if you want to access those higher levels, and it's got the 30% off today only, putting it in the chat one last time, coupon code options30. You want to access those. Oof. Go through that first checkout page, and it's going to ask you if you want to upgrade to that middle tier and then to that highest tier. So that's the way to do it. 14-day money back guarantee. There's literally no reason not to do it. If you spent an hour and a half listening to this webinar, you at least owe it to yourself to try the product for free or risk free rather, right? There's no reason not to give it a go. Just shoot us an email. It's VIP accounts at benzinga.com. You'll get that info if you want to cancel. But again, there's no reason not to at least try it. You'll spend 90 minutes on a Saturday getting educated, then you've definitely got what it takes to take things up to the next level. So hit that link for me, guys. And I will see you all on there, and we'll do this thing together.
Somebody asked about Xpeng. So this is my best guess. I don't know the company, but something's going to happen.
Chinese EV.
Oh, is that what it is? So
That's what it is.
this or that coming soon to a theater near you. Wow, that's a good one. I may do a video on that one.
Boom.
All right, I'm out. Peace.
All right. Thanks a ton, Nick. Go watch your son. And guys, I'll drop my email into the chat. So if you have any questions, but again, there's no reason not to at least give it a go with that 2-week money back guarantee. And I apologize for the mess. This is real life. We're getting some construction done on the house. Love you guys. I love hanging out with you on the daily show that I do from noon to 1 every day. And then, even more fun when we get to do it on a Saturday and see all the same names and faces. So, all right, guys, I'm out. Link going in one more time. See you on the product again. No reason not to give it that go, because you do have that free money back guarantee. You can come find me and tell me you don't like it if you don't, but I've been using it for years, and that's where I learned options. So, all right, guys. And somebody's asking, how do you level up? It's only allowing for basic. The way that you level up is you go ahead and you buy that basic, and then on the next page, it will give you an option to upgrade. Right at the top, it'll give you an option to upgrade your subscription. So you can go ahead and do that. Sterling Johnson's asking, can we get a recording of the webinar? Yes, you will get emailed a recording of the webinar. That's if you're on the Zoom. If you're on the YouTube, you don't get the recording, unfortunately. You can come join the product, and everybody's going to get it there. I got this nice baby blue sweater. I've never bought baby blue before. If you like the sweater, give me a 1 in the chat. If not, give me a 2. There's some feedback there would be nice. But all right, guys. Peace out. Fun hanging out as always. Love talking options. Love talking stocks. You guys make it easy for me to do what I love and get to hang out with smart people like Nick. And I really appreciate it. So, and I appreciate all the ones supporting the baby blue sweater. All right, guys. Take care. Again, I'll drop my email in the chat, luke@benzinga.com. Shoot me an email if you have any questions. You want to hang out, talk stock.